Welcome, astute investors and business leaders. In today's dynamic financial landscape, making informed decisions is paramount. Understanding the company's health and potential goes beyond mere headlines. It requires diving into the numbers, and that's precisely what we'll explore today. We're going to demystify four crucial financial ratios: price to earnings, PE, price to book, PB, return on equity, ROE, and return on assets, ROA. These aren't just arcane financial terms. They are powerful lenses that provide invaluable insights into a company's valuation, profitability, and operational efficiency. By mastering these metrics, you'll be empowered to make more strategic, data-backed investment choices and elevate your financial acumen. Let's begin with one of the most widely used valuation metrics, the price to earnings, or PE ratio. This ratio fundamentally tells us how much investors are willing to pay for each dollar of a company's earnings. It's calculated by taking the market price per share and dividing it by the earnings per share, EPS. A higher PE often indicates that investors expect higher earnings growth in the future, hence their willingness to pay a premium today. For instance, a high-growth technology company like NVIDIA typically commands a significantly higher PE ratio, reflecting the market's strong confidence in its future innovation and market expansion. Conversely, mature, slower-growth companies might have lower PE ratios. Interpreting the PE ratio effectively requires context. A high PE, for example, PE 40x, can signify that the market anticipates robust future growth, but it could also suggest the stock is overvalued. Conversely, a low PE, perhaps PE 10x, might point to an undervalued stock with strong potential, or it could signal underlying problems and poor future prospects. It's crucial to compare a company's PE ratio against its industry peers, for instance, comparing Apple's PE to Microsoft's, and against its own historical average. Additionally, investors must examine the quality of earnings to ensure that the EPS isn't artificially inflated by one-time events, which could skew the ratio and lead to misleading conclusions. This deeper dive avoids superficial judgments. Next, let's explore the price-to-book, or PB ratio. This metric provides a different valuation lens, comparing a company's market value to its book value, essentially its net asset value. The calculation is straightforward: market price per share divided by book value per share. Book value per share represents the value of a company's tangible assets less liabilities on a per-share basis. The PB ratio is particularly insightful for companies with significant tangible assets, such as manufacturing firms, banks, or real estate developers. It helps investors gauge if a stock is over or undervalued relative to the accounting value of its assets, offering a grounded perspective on a company's intrinsic worth based on its physical and financial holdings. The PB ratio holds particular significance in capital-intensive sectors. For industries like manufacturing, banking, and real estate, tangible assets form the backbone of their operations and value. A PB ratio below 1.0, for instance, PB 0.8, could suggest that the market views the company as undervalued relative to its net assets, or it could signal distress within the company or sector. Conversely, a PB ratio significantly above 1.0, such as PB 2.5, indicates that the market recognizes substantial earning power or growth potential in the company's assets beyond their accounting value. However, for service-oriented or technology firms like software developers with minimal tangible assets, the PB ratio is generally less relevant, as their value lies more in intangible assets like intellectual property. Moving on to profitability, return on equity, or ROE, is a powerful indicator of how efficiently a company uses the capital invested by its shareholders to generate profits. Calculated as net income divided by shareholder equity, ROE tells us how much profit a company generates for each dollar of shareholder equity. A high ROE signifies that management is highly effective in deploying shareholder funds to produce earnings, which is a key measure of management effectiveness. For instance, companies like Apple have historically demonstrated exceptionally high ROE figures, Often, Apple ROE 150% in recent years, reflecting strong brand loyalty, effective capital allocation, and robust profitability from their equity base, making them very attractive to equity investors. Complementing ROE, we have return on assets, or ROA. This ratio measures how efficiently a company uses all its assets, both those financed by debt and by equity, to generate earnings. The formula is net income divided by total assets. ROA is a critical metric for understanding operational performance, as it gives a broader view of a company's asset utilization efficiency, regardless of its financing structure. It's particularly useful for cross-industry comparisons, helping investors evaluate how well different companies, such as a pharmaceutical giant like Johnson & Johnson with its Johnson & Johnson ROA 12%, are converting their total asset base into net income, making it a powerful tool for assessing overall business health and competitive advantage. While both ROE and ROA measure profitability, they offer different perspectives. ROE focuses exclusively on the return generated for shareholders, whereas ROA evaluates the return generated from all assets, irrespective of how they are financed. This distinction is vital. Comparing ROE and ROA can reveal a company's financial leverage. If a company has a high ROE but a relatively low ROA, for example, ROE 25% and ROA 5%, it often indicates that the company is using a significant amount of debt to finance its operations. This leverage can magnify returns for shareholders, but it also introduces higher risk. Therefore, using these ratios in conjunction alongside PE and PB provides a comprehensive, holistic analysis, helping investors identify true strengths, potential weaknesses, and overall financial health. In conclusion, mastering key financial ratios like price to earnings, price to book, return on equity, and return on assets is not just about crunching numbers. It's about gaining a strategic edge in your investment journey. These ratios collectively form an indispensable toolkit for evaluating a company's valuation, profitability, and operational efficiency. Remember, no single ratio tells the complete story. The true power lies in their combined application, interpreting them within industry context, and integrating them with other qualitative and quantitative data. By adopting this rigorous approach, you'll transcend guesswork, empowering yourself to make smarter, more confident investment decisions that align with your financial goals. Start applying these insights today and watch your investment acumen flourish.